Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include all the latest from the Fed, my interview with Figure's Mike Cagney on the company's successful IPO last week and how decentralized finance is going to change the mortgage industry for the better and soon. And let's break down the numbers when it comes to first-time homebuyers.
I'm all for making homeownership more accessible and affordable for everyone. I think that's where Credit Expert comes into the picture. They're an all-new credit optimization platform that helps you close more loans. And they're committed to making homeownership affordable for all. To learn more, visit creditexpert.com. No E in expert.
Every battle is won or lost before the battle takes place, said Sun Tzu. Fed Governor Lisa Cook won the last legal round yesterday in her battle to stay with the Fed. Do you think that companies building a factory in the U.S. as we move toward a factory-based economy, with the plant taking 5 to 10 years to build, will face a battle with local authorities on zoning? Does your company foresee any fair lending battles coming up with regulators? Supporting first-time homebuyers is always a battle, and Fannie, Freddie, and Ginnie continue to play a significant role, especially as the share of purchase-oriented mortgages has risen sharply in recent years, averaging 81% of agency issuance in 2023 and 2024, compared to 46% in the prior 3 years. Ginnie Mae leads the way with nearly 70% of its 30-year mortgage issuance last year coming from first-time buyers, the highest since at least 2016, while the conventional side has averaged 44% since 2017. First-time buyers and Ginnie Mae loans tend to have lower credit scores, averaging 701 versus 727 for repeat buyers, and exhibit higher rates of serious delinquencies after the first year. That's 3.9% versus 2.5%, compared to 0.6% versus 0.4% on the conventional side. While debt-to-income ratios are similar across buyer types in both loan categories, first-time borrowers generally face greater financial vulnerability, which translates into riskier credit performance, especially for Ginnie Mae loans. In the conventional space, repeat buyers are more likely to make early curtailments, thanks in part to using products from a prior home sale, making their loans more attractive for investors seeking reduced buyout risk. Turning to rates, bonds rallied yesterday ahead of today's start of a 2-day FOMC meeting that is expected to conclude with a 25 basis points rate cut. Concerns over tariff-driven price pressures have diminished somewhat, with recent CPI data failing to show any sustained breakout. The idea of an inflationary shock from tariffs has given way to expectations of a slower, more manageable pass-through, extending the timeline for any material price increases, and helping to reduce investor anxiety while providing the Fed with more room to maneuver. With inflation no longer viewed as an imminent threat, the Fed's focus has clearly shifted towards shoring up labor market conditions. Still, the broader macro narrative remains fragile. Labor market data, especially the sharp downward revision of over 900,000 jobs, has cast doubt on the economy's resilience earlier in the year and highlighted the lagging nature of employment indicators. This reinforces the perception that the Fed's July pause may have underestimated the extent of labor market softening. Despite relatively steady jobless claims and strong asset markets buoying consumer sentiment, the soft data and disinflationary pressures suggest a more vulnerable economy than headlines might indicate. For today's interview, I wanted to welcome to the show Figure's Mike Cagney to talk about the company's successful IPO last week and how decentralized finance is going to change the mortgage industry for the better and soon. He's co-founder and CEO of Figure Technology Solutions, which is a financial services company, and he's a member of the founding team of Provenance Blockchain and the co-founder and former CEO of SoFi.
Unless you live under a rock, you probably saw that Figure IPO'd this week, and that's me speaking to my audience, and there was a great market response to it. I want to start the interview by asking you, what have the last 72 hours been like? Probably a lot of congratulations and who knows how much sleep. Fill me in. Fill us in.
Yeah, I mean, obviously a lot of people reaching out and congratulating us on a process. We started back in 2018. A lot of people were watching very closely the evolution of the business and what we were trying to accomplish. I mean, honestly, other than having to respond to an enormous number of emails and texts and trying to be considerate and courteous, this is just a step in the process, right? I mean, it's not the end goal for Figure. It reinforces, especially with the market appetite for the IPO, reinforces how much work we have to do in front of us. I think the most stressful thing about being on the IPO process and on the roadshow here, but not being able to do them because we're in meetings talking to people about it, right? And so to me, I'm just happy to get back to work, just being very focused on executing into this vision. One of the things that was nice about the IPO process is it really reinforced my excitement and enthusiasm for the opportunity that we have. Being able to talk about it and interact with investors on it in terms of what we're trying to do, really just in terms of transforming capital markets and starting with the mortgage ecosystem, it solidified my belief in what we have in front of us, which is an enormous opportunity.
You mentioned it there a little bit and you kept it kind of cursory. The evolution of the business and what you're trying to accomplish. What has the evolution been? What are you trying to accomplish?
The focus that we have is around using blockchain to change capital markets. And we knew to do that, we would have to be first adopters. So we stood up a direct-to-consumer HELOC origination platform back in 2018. Pretty quickly, we evolved that to business consumer. We now have over 170 third parties that use that technology to originate assets, including 10 of the top 20 mortgage retail shops. And then, one of the key evolutions was the development of Figure Connect, the marketplace. So allowing our origination partners, rather than selling to us as an aggregator, selling directly to the capital markets using our blockchain ecosystem. And that's been a super important progress to the model. It's much more profitable for the partner. And then our ability to expand into first lien. It costs us $1,000 to originate a mortgage. It costs Fannie Mae, on your Fannie Mae platform, $12,000. So you have a massive cost advantage. And what we've seen is, a year ago, we were 150 basis points wide on rate to a Fannie Mae first. We're now pretty darn close to that rate, especially after that last securitization that we did with the Moody's AAA. So, I think you're going to see a big push, or what we want to do is a big push into the mortgage industry of sub $500,000 loans going our route versus agency route, because we think we can deliver a competitive rate, a better economic, and the same guaranteed takeout and liquidity that the GSEs offer.
Mm-hmm. There was an incredible market response to this. I think I saw stock pop by 44% versus analyst expectations, and that might have been middle of the trading day. Maybe it was more by the end. Let's single out my father here, who will be up on stage at conferences, and he'll go, "What happened to blockchain? We thought it was going to take over mortgage and well, it seems like it is." What does the market response say about the belief in this? Where are we now with blockchain when it comes to mortgage, and how do you see that continuing forward?
Yeah, look, I think what we've done is we've demonstrated the first two of the three value props of blockchain, right? The first was transactional efficiency. And back when we started, we went and pitched everyone 85 basis points of cost savings to originate, aggregate, and securitize assets on chain. Well, I think we've demonstrated significantly more than that. A clear example is in securitization. To get a AAA rating in a mortgage transaction after 2008, every loan gets audited. It's $500 a loan. That's just how it worked. Because of the immutability of blockchain, the way we ingest data, we audit 20 to 30% of the loans at $100 a loan. And that in itself is the difference between $1.3 million and $100,000 on a deal. It's over 50 basis points of cost benefit. But that compounds because generally you audit those loans 2 or 3 times over the life cycle of the loan. Again, here you only do it once. The liquidity benefit is what we really just turned on last year with Figure Connect, right? The ability to directly access the capital market and provide for a medium. And for liquidity to occur, you need a couple of things. You need ubiquity of an asset, you need consistency of contract, and you need certainty of information. And the ubiquity of the asset, all 170 plus third parties we have all use the same technology to originate the asset. There's no human involved. And eliminating that subjectivity ensures that it doesn't matter if it's guaranteed rate or movement or figure, they're all the same loan. And that ubiquity coupled with standard contracts. So what we did is we created a marketplace that has one loan purchase agreement. And so they're not one-off negotiated, Apollo has these reps and stips and KKR has these. Everybody in that marketplace operates off the same doc. And then certainty of information, all the remit of those loans is fed into the blockchain. So I know whether those loans are current, whether they're delinquent, whether they defaulted. And the combination of those factors has afforded us the ability to stand up liquidity. So we run bid wanted in competition auctions weekly. We run a limit order book continuously. And with the guarantor, with the deal we did with Sixth Street, we now have brought in the ability to effectively do a TBA, a to be announced security market for that marketplace. What we're really doing is trying to bring Fannie Mae, GSE type execution certainty and liquidity into markets that have never had it. However, we're also now competing into their market because of the cost advantage we have on producing the asset. That gets you to the second level. The third level, and the one that we're starting to lean in now, is around DeFi. And DeFi, decentralized finance, is in its purest form just directly connecting sources and uses of capital. And what we're doing there is we're saying the thesis that we had, we would look at crypto DeFi platforms and people could borrow against their Bitcoin or their Ethereum at a fraction of what it would cost in the wholesale capital market. And so we stood up a DeFi platform called Democratized Prime, and we started bringing our loans over there. And sure enough, we were able to finance cheaper than our Goldman warehouse, right? And we brought $10 million of loans over. We did it. We brought another $10 million of loans over, did it again. So what I'm in the process now working with our team on is standing up $1 million of loans that is effectively a warehouse facility for our partners. So rather than them having a bilateral warehouse agreement with Goldman or Jefferies or whomever else they might have, they're going to use DeFi to aggregate their assets cheaper and then contribute them into transactions. And that's sort of the last leg of the process. So I was working with a lot of people in the mortgage space, and everyone was very skeptical on blockchain. What we've quietly done over the last many years is built a significant blockchain infrastructure and capital market ecosystem. And this last leg, the financing leg, the DeFi leg, is really kind of the end of the process to create something that we believe is much better than what we had before.
Why IPO? Obviously, there's pros and cons, but from a capital standpoint or from a flexibility standpoint, that sort of thing. Ultimately, this, you're not new to this game. What was the rationale behind doing so?
Yeah, look, I mean, being public introduces a lot of challenges. And, some of those challenges are the enhanced regulatory and compliance scrutiny that you have. Some of them are, the market every day gets to judge whether they like you or not. And you have to abstract any personal feelings from that. But for us, the key word was really twofold. At first, I believe just like there's the Magnificent Seven in Web 2.0, you're going to have that in Web 3.0. And I believe Figure is one of those companies. No one has done more real world asset transactions on blockchain. We've done over 17 billion of originations of loans on chain. No one's done more blockchain native transactions, over $50 billion worth. No one's brought TradFi into blockchain the way that we have, and we're just getting started, right? And so, being able to go to the public market and tell that story, build that narrative was really important to us. But also, I always go back to when I was at SoFi and we raised $1 billion from SoftBank, and largest private raise any company had ever done at that point. And it was a needle mover for us in terms of having that capital on the balance sheet, allowing us to take risk and lean in and do things our competitors couldn't. And I saw the capital on the table here on the public market side, and I said, let's take it. And so our balance sheet is in a position where we can take risks that a lot of our peers aren't able to take.
I'm going to ask for a couple technicals here for people that aren't familiar with the IPO process. What are the steps to actually IPO? From my perspective, I just couldn't really talk to you or Mikey Tannenbaum for the last couple months. You're so busy and locked down.
Yeah, I mean, that's the biggest misperception people have is they're like, oh, the IPO market's hot. You must have decided to go public. It's like the decision to go public was over 6 months ago. In our case, it was over a year ago because we knew we tried to go public last year and just felt the regulatory environment wasn't ready, and we went pencils down. So it's a 6-month process. And there's an enormous amount of work that you have to do on the accounting side to ensure that you're ready to be public and deal with the reporting. There's an enormous amount of work on the investor side. It used to be you would do an IPO roadshow, and then they started introducing these concepts of test the water meetings, especially after during COVID. And we probably did 150 meetings to pitch this idea. And the beginning meetings are very iterative. You're getting a lot of investor feedback in terms of what resonates, what doesn't, what they're interested in you focusing. And you have to be careful not to be overreactive to it. Like we had one investor meeting where they yelled at us for being profitable, and we're like, well, we're not optimizing to be profitable. Just it's a number that drops out because we spend less than we earn. But it is very involved and it's all consuming, and that's really was the most stress for me, was being out and doing those investor meetings and driving that enthusiasm and not having the time to do the work we needed to do around all the things that we talked about. So I'm as I said when we started the conversation, I'm just glad to be back at work.
Yeah. And I don't want to belabor the point here, but this will kind of be me putting a bow on it, and it'll be my last question. What's next? You mentioned decentralized finance and some of what that allows you to accomplish, but to your credit, you've always been way before the leading edge. And so when I ask you what's next, like what are you seeing? Where can this evolve into?
Yeah, look, I mean, I think as it relates to credit, as I said, the DeFi side and moving bilateral warehouse agreements onto generalized decentralized finance is pretty cutting edge. And, I think we're going to be at the forefront of that, the vanguard of that work. But, we're extending this outside of credit too. It won't be on DTCC. It'll actually be on the blockchain. You'll trade it on the blockchain. It'll be cross-collateralized to any blockchain asset. Introduces a bunch of really cool things around controlling it for stock loan and margin and so forth. And I think that'll be the beginning of us extending this value prop into things like commodities and currencies. It's not just a credit story. It's an important credit story. And I love credit because it's been greenfield, but there's a lot of opportunity across all asset classes.
Yes. And I want to applaud you for picking the right product at the right time, at least when it comes to the lending side of things. More than anywhere from 7 to 15 or $20 trillion of tappable equity, maybe $30 trillion by some estimates. It seems like the right time in this interest rate environment. So congratulations on that. Congratulations on the IPO. Always a pleasure talking to you, and I'll see you somewhere soon.
Thanks for having me on.
Today's economic calendar is packed with data and began with retail sales, which came in up 0.6%, much stronger than expected, and excluding auto, we're up 0.7%. We've also received import and export prices for August. Imports were up 0.3%, much stronger than expected. And later today brings Redbook same-store sales for the week ending September 13th, business inventories in July, the NAHB housing market index for September, and Treasury activity that will be headlined by $13 billion of reopened 20-year bonds. We begin the day with agency MBS prices unchanged from Monday's close, the 2-year yielding 3.53%, and the 10-year yielding 4.05% after closing yesterday at 4.03%. Let's wrap up with a joke and some housekeeping. Why couldn't the pirate take his son to the movies? Because it was R-rated. Okay, a Native American, pirate, and Frenchman walk into a bar. The bartender says, "Gentlemen, how are we today?"
Thanks again to Credit Expert for sponsoring this week's podcast, the all-new credit optimization platform that helps you close more loans. Credit Expert is committed to making homeownership more accessible and affordable for all. To learn more, visit creditexpert.com. No E in expert.